precious metals have outperformed both real estate, the S&P, and bonds over the last 25 years, 20 years, 10 years, and 5. So if you want a top investment, why not have it included in your portfolio? Secondly, I recommend about a 10%. So I'm not saying don't do the S&P 500, put it all into gold. I'm saying put gold in your. Third point is that the best portfolio analyses done in recent times have been by Ibbotson and Associates. I looked at a portfolio weighting, and what they found was that a 15% weighting to the precious metals, not gold or gold stocks, but gold, silver, and platinum, outperformed any time, good time, bad time, inflation, deflation, stagflation, didn't matter. 15% weighted to the precious metals outperformed any other portfolio mix.
What if one simple asset could strengthen your portfolio through inflation, deflation, recessions, or booms, and even outperform traditional investments over decades? David Morgan believes precious metals are exactly that. He argues that precious metals are unique in their ability to perform across all economic environments, whether inflation, deflation, recession, or growth. Over multiple timeframes, they have consistently outperformed real estate, equities, and bonds. At the same time, Morgan highlights how rising gold prices impact mining companies differently. Marginal miners, those producing gold at near break-even costs, can see their profits multiply disproportionately when prices climb. A $300 move higher in gold may not mean much to a low-cost producer already enjoying wide margins, but for a marginal company, it can be the difference between barely scraping by and realizing a huge percentage gain. This dynamic explains why leveraged, marginal miners often outperform during bull runs in precious metals. Still, Morgan cautions that while miners can offer outsized gains, they also carry risks that physical gold never does. Mining companies face challenges like labor strikes, flooding, or political disputes that can erode performance. Physical gold, by contrast, simply exists, stable, tangible, and immune to such disruptions. Even so, the current environment has seen gold stocks outperform the metal itself by nearly 2-to-1, underscoring why both miners and bullion deserve a place in a well-rounded strategy. If you found this video helpful, don't forget to like, share, and subscribe to stay updated. We'll continue delivering sharp insights and expert perspectives on the forces driving gold, silver, and the broader financial landscape. Thanks for watching.
Correct. If I just give a real quick example, I think everyone can follow this. It's not all that intuitive, but if you're a marginal miner, so gold's at 3,000 and you're mining it at 2,900, you're just making $100 profit. But if it goes to 3,300, now you're making $400. So that's a huge percentage gain in that marginal mining company. Whereas a company that was mining it at $2,000 and the price is 3,000, they got $1,000 margin already. And when it goes up that other $400, the percentage gain is not nearly as much. So what happens in those highly, what we call leveraged companies that are marginal, if we get a big run in price, those actually perform better because the percentage gain to the bottom line is so significant relative to a company that had a wider margin. I hope you follow. Absolutely. I've preached that from day one. I don't sell bullion, although I can connect you if you're a big investor to probably one of the lowest premium places I know of from all my time in the industry. But that's it. And then it's just sitting on the shelf or in a bank or in a vault somewhere. And it's the safest, easiest. In fact, gold itself has performed as well as some of the miners through some of the recent history. So why take the risk of a company that has labor disputes, maybe the mine floods, jurisdictional issues, or what have you? Whereas gold sitting on a shelf is pretty much exempt from any of those worries. However, the sector's heating up now, and the gold stocks are outperforming gold 2-to-1. So gold has gone up substantially, said from where it was to where it is now, where the mining share. So gold's up like 40% for the year, and the miners are up about 90%, the top tier. So you're better off in the miners right now, but I always have strove for both, and the safest is the metal itself. Well, I think there's probably 2 or 3 bullet points. Bullet point number 1 is that gold, as I said earlier, precious metals have outperformed both real estate, the S&P, and bonds over the last 25 years, 20 years, 10 years, and 5 years. So if you want a top investment, why not have it included in your portfolio? Secondly, I recommend about a 10% weight. So I'm not saying don't do the S&P 500, put it all into gold. I'm saying put gold in your portfolio. Third point is that the best portfolio analyses done in recent times have been by Ibbotson and Associates. I looked at portfolio weighting, and what they found was that a 15% weighting to the precious metals, not gold or gold stocks, but gold, silver, and platinum, outperformed any time, good time, bad time, inflation, deflation, stagflation, didn't matter. 15% weighted to the precious metals outperformed any other portfolio mix. And there's one more recent by CPM Group in New York, New York. Jeffrey Christian runs it. We've been friendly for years. He did an analysis from 1968 onward, so it's not going back as far as Ibbotson. And he found a 25% weighting to gold was the exact amount you should have if you wanted a maximum portfolio safety, diversification, and performance. So that would be my message: is that it's not an all or nothing, but it is diversification, and the only asset class that's negatively correlated or inversely correlated, you can think of it inversely correlated to the stock market, is gold, not gold stocks, but gold. And so that's something to consider as well. If you're a business owner and you want that, business insurance, that if this happens, or key man insurance, or whatever you have based on, your livelihood, your business, you're trying to build it up, maybe you're going to sell it, whatever, that is something that you really want to protect. Well, if you want to protect your business from a financial conundrum, or retire early, if you haven't, I guess last point, I'm going to digress slightly, but one of the largest brokerage dealers in the world, one of their key guys that managed, wealth manager, but I mean, he was truly a wealth manager. This guy didn't touch any account that wasn't in like the 10 million and up category. He called me from Europe and we had a nice little chat. And he said, I've worked really hard, done this, I've done really well for, my clients, but really I could have just stuck them in gold the whole time and done just as well. Could do both, but I actually recommend the physical gold first. Once that, because that covers all cases. That call, weather issue, you have a hurricane or whatever, you can pick up a gold coin or whatever. Um, a power outage, a bank closure, who knows? Now, if those things are at the tail end of the curve, and I will admit that, but if you're going to protect yourself, why not protect yourself all the way? Once that's established, maybe you're, pretty high net worth, and $10,000 in gold is enough, but you want to invest 50,000, so you put some in the physical coinage and the rest into an ETF. As long as you've established some physical, I don't really care if you go to an ETF next, but I would never consider an ETF to be a primary gold asset or silver asset. Gold's the most liquid thing in the world. I mean, people that say that probably haven't experienced the market. I mean, an ETF can be sold with a mouse, but I mean, the cumbersomeness of gold is, maybe you have to take it to a coin dealer, but you really don't. I mean, if you buy it over the web, you can sell it with a mouse click. All you have to do, they'll send you, instantly a FedEx form that you print on your printer, stick on a envelope. It's insured and everything else. You drop the coin or coins in there, put the label on it that they sent to you, and put in the mailbox. If that's too hard for you, then you're not much of an entrepreneur. I mean, it's pretty easy to. And the other thing is, when we have fighter pilots out there fighting, in foreign lands, their survival kit has a gold coin in it. Why is that? Well, because they got shot down and they've got to negotiate their way out of a hostile territory. They use the gold physically to give it to the border guard or whomever to get out of the country. So, I mean, there's a lot to, well, it's kind of the mindset of North Americans. Most people outside of North America have a different attitude toward gold than North America. It is because it's been money for 5,000 years, and the system is based on a banking system, and the central banks have been buying gold hand over fist. So they look at it as the money of last resort. If you go to one of the original gold bugs named Jim Dines, he called gold the monetary hitching post of the universe. I mean, currencies have come and gone. All fiat has always failed. The US dollar is a fiat. It's failing as we speak. And gold has always risen to the top. In other words, the free market has determined gold to be money. Why? Well, it goes back to Aristotle, what money really is. It's got to be fungible, so all gold is the same everywhere, divisible, scarce, recognizable. And so it fits all the properties of money. And that's really what it's work. Now, does that mean it's going to work in the future? No. Does that mean you couldn't go to a crypto world in the future? You could. But right now, we've got 5,000 years on gold side, and there isn't anything else that has that track. In fact, the stock market peaked in the year 2000, and we're in 2025. The stock market peaked in the year 2000 relative to gold. One of the books back here is
If you
called
if you priced it in ounces, you mean?
Yeah, absolutely. There's a book back here called The Invisible Crash, and that was brought to my attention early in my studies that if you measured the stock market in terms of gold, even though it was going up and up and up and up, in gold terms, it was going down and down and down. And this is something that's a very difficult concept for Americans to actually conceptualize. But once they get it, you can't turn off the aha moment.
David Morgan emphasizes that precious metals, particularly gold and silver, have consistently outperformed traditional assets such as real estate, equities, and fiat currencies across multiple timeframes. Their ability to preserve purchasing power offers a clear advantage during periods of currency depreciation and systemic upheaval. Unlike a simple redesign of money, he suggests the world may be facing a structural reset reminiscent of Bretton Woods, with the current trajectory pointing towards central bank digital currencies. In such a landscape, gold stands out for its constancy. An ounce weighs the same anywhere in the universe, serving as a reminder that it is currencies, not gold itself, that fluctuate in value. At the same time, Morgan notes that gold's utility extends beyond bullion or coins. In places like Argentina or Venezuela, where currencies have collapsed, gold and silver, even in the form of jewelry, have become practical mediums of exchange. This underscores why metals remain central to wealth preservation. Yet his analysis does not stop at precious metals alone. It also extends to broader resource markets, including lithium, cobalt, rare earths, and copper. Together, these assets create a bigger picture of resilience in a changing economic system, where hard money and tangible resources continue to hold enduring value. Let's get back to the interview.
So, why precious metals matter to small business owners? First of all, there's wealth preservation. Most small business owners keep excess reserves in banks, but metals offer a hedge against inflation in a financial crisis, protecting their hard earned profits. Second is diversification beyond the business. Entrepreneurs usually have their wealth tied up in one asset, and that's their own company. Metals provide an uncorrelated diversification. Liquidity and flexibility, both gold and silver can be converted to cash easily. And if opportunities or emergencies arise, unlike illiquid assets such as real estate or private equity, metals are always there to turn to cash almost instantly. And it's a hedge against systemic risk. Many businesses rely on credit. The banking system seizes up, as it has in the past crises, having a reserve in physical metals as a backstop. Lastly, if you save in metals, you're going to preserve your wealth, maybe even have an advantage to the depreciation of the currency. The compounded annual growth rate of the metals on a 25, 20, 10-year, and 5-year time frame have outperformed real estate and the stock market. Certainly, it's beat the heck out of whatever denomination currency. And of course, we're talking probably primarily to US investors. So there's that. I just had a couple more things. One is that most of my subscriber base for my private work, the paid subscriptions, are small business owners. These are people that have worked probably harder than the average person, have the entrepreneurial spirit, they know the value of a dollar, and don't want to, give that up. In other words, they want to preserve it. So that's the majority of my business. As far as a reset is concerned, this is more than changing the currency or changing the size of the dollar or the color of the money or that type of thing that some of my peer group refers to when I'm talking about something that happens every 250 to 400 years, which is really a whole new system. It would be similar to what happened at Bretton Woods after World War II, where all the banking and power elites met in Bretton Woods, New Hampshire, and pounded out a new monetary system based on the US dollar, and the dollar is tied to gold at $35 an ounce. That's what I'm referring to, that kind of a reset. This time it looks as if we're being steered into a central bank digital currency or something similar to that from the private equity side, or I should say the private business side.
Interesting.
Absolutely. An ounce of gold is the same mass anywhere in the universe. It doesn't change. One of the best books behind me here is called The Golden Constant. And what it says is what you just said, David. The gold didn't change. The currency changed. Both, first of all, a trend in motion continues until it actually stops. So the trend is more and more depreciation of the currency. And as I said earlier, it usually accelerates at the end. So a business owner that's using credit has got to be aware that they want to lock in a fixed interest rate if at all possible. If they have a variable rate based on the inflation rate, you're in trouble. Also, that prices will be forced higher by suppliers. So if you're in a middleman position where you buy something from the Philippines, mark it up after it's imported, pay the tariff if there's one, and then mark it to a reasonable margin for your business. That could change over time, and it could be a situation where if it's something that's a want, not a need, you might want to think that through. So it really destroys the whole business environment. There are sectors that will do very well. There are sectors that will get hurt, and really it's out of the control of some of the business people because you can't really control the depreciation rate of the currency. You can mitigate it to some degree. For example, if you have something that's needed, your business is great, maybe it's even growing, and you don't use credit, you might be able to buy, whatever widget you're reselling for X price from the Philippines or South America or Europe, wherever you get it, and warehouse it or whatever. Now you've kind of locked in a fixed price that's probably going to continue to go up just because of the inflation problem. It does. In fact, I don't have it at my fingertips, but my friend Mike Maloney put out a video. It's actually put out by somebody else. I found it. He found it. He put it on his platform. I forget. It's a South American country. It could be Venezuela. It might be Argentina. I forget which. And they price everything in grams of gold. So, as you said, using your phone, they use their phone and basically find the day's price of gold, and they measure it out. And people think, "Oh, gold," and most Americans think gold coins, which is fine. But really, I've actually interviewed people from Argentina that's gone through that inflation destruction a few times. Happens about every decade, and in that case, it's like gold chains, gold rings, gold bracelets. It's jewelry gold that you could cut off and weigh and pay for groceries, for example. Yeah, for a real in-depth look, the book, Silver Manifesto, has a whole chapter. It's a lengthy chapter on how we value a mining company. But from the broad brush perspective, gold valuating a mining company is more difficult than most businesses, but the end product is simple because whether it's Newmont Mining or Barrick Resources or Agnico Eagle or any of the major gold miners, the end product's identical. It's fungible. Gold from South America is identical to gold from North America, gold from Asia. So that part is like, okay, so who has the best margins on gold? Now we look at what's called free cash flow. That's the best way to value a mining company. A PE ratio really doesn't work very well for mining analysis. So we go through that in the book. It's pretty simple. And we are different from most of the people that write in the resource sector. We write about the macro picture in the economy, the worldview, and then we drill down into hard money, but primarily resources. We look at lithium, cobalt, the battery metals, rare earth elements, copper, you name it. We've covered it. And of course, gold and silver are right up there, but it's not just precious metals.
Precious metals provide both stability and opportunity, serving as unmatched stores of value that offer security, liquidity, and protection against systemic risks such as inflation, deflation, or financial crises. At the same time, mining companies, particularly marginal producers, can deliver magnified gains during bull markets, even though they carry higher operational and geopolitical risks. Over decades, historical evidence has shown that precious metals consistently outperform traditional assets like real estate, equities, and bonds, while also enhancing portfolio resilience across every economic cycle. This unique combination of safety and growth potential makes them not just a hedge, but a cornerstone of diversification, wealth preservation, and long-term financial strength. How can investors strike the right balance between holding physical precious metals for security and allocating to mining stocks for higher potential returns? So, stay tuned for clear, data-driven insights into the financial system. Be sure to like and subscribe so you never miss our weekly updates. Thanks for your support, and we hope you enjoy the video.